Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Finally, we are on Friday. And what a week it has been. Started with an all-time high on Monday and, is looking a little despairing now as we close this week out. It's an important one, especially after market hours. Two triggers, which I think will dominate how we trade on Monday morning. We'll discuss all of that. We're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Nigel and Reema. Guys, good morning.
Hi, good morning. It's been a near 500-point fall on the Nifty just in the last four trading sessions. The big fall, of course, came yesterday before consecutive session of losses. And not just the global triggers that we're watching today, the jobs report and the Supreme Court verdict on tariffs. Next week is such a big week in terms of earnings, whether it's tech, it's banking names, Reliance Industries. It's, will be mark time today is the question ahead of that.
Well, that's right. What a start to 2026, right? I mean, so many cues for the equity markets as well. And on a personal front, when I wrap up this week, I'll be just, reflecting on a couple of losses in the start of 2026. Mr. Anil Agarwal's son, as well as Sid Bhaiya. Just tells you how fragile life is, right? And uncertain. So I think today it's not going to be about the party or about the end of the week. I think I'll reflect a little bit because... that's something that really has put me a little bit off at the start of 2026. But we've got markets to deal with, so let's get straight
absolutely. And I think, the theme seems to be uncertainty and a very uncertain environment everywhere out there. Let's just take a quick look at what you need to know as we begin this fresh trading session. What do you have, right? I mean, U.S. equities are mixed. Actually, it's not so much price action once again from last night. The S&P flattish, NASDAQ is down about 0.4%. And there are two big cues. I'll sort of, come back to what happened last night once again, but I just want to start and address what is most important right up front, right? So you've got Trump tariff ruling, which is number one, and you've got the U.S. jobs data, which is number two. So the Supreme Court ruling on Trump tariffs will come our time later tonight at about 8 o'clock. We should have it, most likely. And the U.S. jobs data, of course, comes around U.S. market opening time. And there the consensus is for about 70,000 jobs. I'll come to that. Now, consensus also is, if you look at prediction markets, they're saying that there is a chance in the high 70s that the U.S. Supreme Court will partly strike some of these tariffs down. So all tariffs, no tariffs, some tariffs, but, perhaps there will be some action and most likely perhaps a partial kind of rollback. Now, these are the emergency powers that President Trump used to impose all these tariffs. So for all these tariffs, right, these are the IEEPA tariffs. And that is what we're talking about here. Now, I said this yesterday as well. If it were to come to that, the Supreme Court partially strikes down these tariffs, expect President Trump to come out strongly and, of course, say, well, the decision from the courts is wrong and that he will find a way to put these tariffs back on. Tariffs have been central to the Trump administration's policy from day one, and don't expect them to back off. So if there is a decision, don't think, well, tariffs are over. They're not over. They will find other ways. There are other sections to do it. The IEEPA tariffs are the section under which all these tariffs were imposed over the last year were the most convenient, fastest, quickest way to do it. There are other sections. They are more cumbersome, may take more time, but they can do it. So I think that is what we are looking at. Now, the question for us in India, especially us in India, first of all, just in an absolute headline tariff level, we are one of the worst hit. So in that sense, right, can the Supreme Court striking down at least even part of the tariffs be at least a short-term, can lead to a short-term risk rally when we come back on Monday? And I think the answer perhaps is in the yes, if it does come to that. Because, for at least a few days, even if we hear from President Trump, there will be confusion. People will start to look at these sections. How long will it take? It will certainly take longer than just a stroke of a pen like he's used the IEEPA ones. So does it provide a window? Some breathing space is the question. And I think perhaps as I said, the answer is yes. Now, the other one, which has not been talked about at all, right, is the fact that U.S. Ambassador Sergio Gore will be in India U.S. ambassador to India, will be taking charge, will be here starting Monday, this coming week. He was here, remember, on that flash visit, met many leaders, Prime Minister Modi as well. Now he's back here permanently. The reason that is important is that, several people like Ashok Malik, etc., have said that Sergio Gore has got direct access to President Trump. He's in the inner circle. He's he's not a typical career diplomat. Him being here, he can cut through the bureaucracy and get President Trump on the line. So at the margin, it is a positive. Will it lead to something? I think we'll just have to wait for it. But at the margin, that is one more point which I think the markets will be paying attention to. Okay, so that's the US bit, right? Now, just from going back to last night's action, oil prices were up 5%. So there's a big pop, $63 a barrel. No specific reason. Down and up, but from 60 and 63, that's been the range for the last 1 week or so. Two largest mining companies are saying, well, they may merge. Glencore and Rio perhaps are in talks to form the biggest miner in the world. In the same vein, in terms of commodities, silver was down sharply, 5% or so, but it kind of sort of recovered and ended down about 1%. Defense stocks, I think the one enduring theme from everything which is happening, all these uncertainties, the fact that everywhere defense spending is going to go up. Remember, defense stocks all sold off the prior session. They were up last night. Lockheed was up 4%. Trump essentially is calling for a 50% increase in military budget as far as the US is concerned. Trump also gave an interview to the New York Times, and he said, well, he's made up his mind on the Fed chair pick. Besant basically was also on the record saying that current interest rates are far above neutral. And when he asked where should rates be, he said, 3%. He said consensus is 2.5 to 3.25%. So that's the other one. And this is again going to be a big factor. How much pressure, how much influence can the executive branch in the US put on the Federal Reserve to lower interest rates? The Fed pick, etc. It's something we will have to talk about. Now, just to tie in the levels here, yesterday, of course, was a very, very bad session. From the highs on Monday, all-time highs on Monday, the Nifty is down about 500 points. Bank Nifty is done much better. It's down about 1.25% or so. The small cap index, the mid cap indices, small cap closed exactly at the 20-day. The mid cap index closed below the 20-day. So these moving averages are all under are breaking, straining, have broken. And I'll just leave you with those levels once again. The key 20-day moving averages, as I've done for the last many days, 26,044 is that level. We are under it. And of course, the Nifty Bank is 59,409 or so. GIFT Nifty up on your screen gives you a quick sense, about 12 points. So very undecided going into those important events later today. Nigel has walked across to the wall with the F&O positioning. Nigel, over to you.
Well, yesterday the session belonged to the bears, right? No two ways about that. The Nifty ended way below the 20 DMA and the broader markets as well sold out. So yesterday, in the sense, was a bit of a backbreaker for the bulls because still yesterday, actually, they would still have their hopes up. But let me get to a couple of data points that actually they could be banking on. The problem now is that the FI net sell number, well, that's perked up. Remember, their participation was low. As their participation is picking up, the sell number as well is picking up. So at around 3,400 crores odd, that's getting to be a bit of a worry. In trade yesterday, besides the FI selling, that appeared that there were shorts that were getting accumulated into the Nifty, on the futures segment. While on the Nifty Bank, actually, the open interest was down, telling you there was some unwinding of long positions out there. Yes, the structure is weak on the Nifty, but there are a few technical factors that the bulls will be banking on. First up, in terms of the short positioning yesterday, it went up big time because the shorts that the FIs added were close to around 31,000 contracts. I'll tell you what, this is the highest FI net short build-up in the last 7 months in absolute terms. More than 30,000 contracts in a single trading session. And the short positioning now moves to around 91%. So you have shorts in the system, but we need that good news to come for this, in fact, for the shorts to get covered out. So that's point number one. FIs aggressively net short. The clients, they're doing the reverse of what the FIs are doing. So in yesterday's trading session, they added some long positions. More than 12,000 contracts is what they added. And if you look at it in absolute terms, the FIs are aggressively net short, as that is telling you, while the clients, the long positioning is at the highest we have seen in the last 3 months or so. Normally, this combination actually is good, and that's when we see a bit of a bounce. On the options data side, which is the second data point I'm making, the first one was the FI is a net short. The second data point is that the PCR has come to the lower end of the range. Remember, the start of this week, it went to around 1.5. Now it's come to around 0.66. At around 0.6, 0.63, we have seen a bit of a bounce. That's the other data point. Then if you look at the Nifty and the gold ratio, that's come to sub 2 times. Remember, in the past, whenever we have seen this, more often than not, you've seen a bit of a bounce from these levels. So either this is the new normal, closer to around 2, but otherwise at around 2 times, you do see a bit of a bounce. While at around 3 plus, that's when the returns get a little bit subdued. And at around 4 times, it doesn't turn profitable from a bullish perspective. Moving to the options data, called writers, well, they are having a gala time. 26,100, 26,000 call, 26,050 call. Aggressive writing is what we have seen. So they believe that these upper levels are going to get protected. To put in a few levels, well, the support zone is around 25,500 to around 25,700. I say this because even in December, we visited this zone, and from there, we did see a bit of a bounce. While the 20 DMA, that becomes the crucial resistance mark. The two big constituents of the markets will have to come and, bat for the bulls. Because, yes, the Nifty has broken that 20 DMA, but the Nifty Bank, that's still a little bit away from the 20 DMA. You don't want that level to break. And Reliance Industries, the big boy, has corrected from the top. It's getting closer to around the 200 DMA, so you don't want this level as well to break. Both the Nifty Bank as well as Reliance Industries will have to play well from here on to defend the Nifty. And as I said, select factors are suggesting we're getting into a bit of an overstretched zone on the downside.
Thank you very much for that. Reliance Industries numbers are next Friday, post-market hours. And then on Saturday, that's 17th, you've got HDFC Bank and ICICI Bank reporting numbers. And through the course of next week, lots of IT names, whether it's TCS, HCL Tech, Infosys, LTTS, many mid-caps will be reporting numbers between Monday and Friday. But post-market hours next week, you'll have Reliance and the two large private sector banks. But let's get you the equity calls then. It's Rupal Agarwal of Bernstein who believes India is presenting a balanced risk-reward setup, warranting a neutral stance. So she says, while stretched valuation, potential risk, a potential rise in risk premium, challenging stock picking environment, lack of macro recovery, and even the valuation earnings support does create some near-term challenges. She sees positive tailwinds from strong earnings recovery cycle heading towards upgrades, reasonable relative valuations, low long-term earnings growth expectation and potential return of foreign capital, resilient domestic flows and likelihood of a US-India trade deal offsetting the negativity. But in a nutshell, I think the call is from Rupal Agarwal of Bernstein that the setup appears to be neutral. But let's invite Neeraj Sheth, founder and chief investment officer at 3R Investment Management, now joining in. Thank you very much, Neeraj, for joining in. Top of mind is the uncertainty swirling around the US trade policy, the Supreme Court potentially ruling on the legality of Trump's emergency tariffs later today. So the question is, how will the market react in the various scenarios? One, there is a partial strike down. Two, in case there is a full strike down. And in that event of any strike down, what is the market assuming on how quickly and effectively Trump can impose alternate tariffs? What are the legal avenues? And then in the event there is no change, how should markets react on Monday?
So I think overall you will not see a significant reaction with the exception of maybe the immediate knee-jerk. I think two aspects you have to think about. One, from a tariff perspective, if anything, you've seen the tariffs getting watered down over the last 6 months. In fact, post-April, if any, the tariffs have been obviously seeing exceptions to obviously manage inflation and other supply chain aspects. So it's not as if the headline tariff with what it was expected to be is where we are. We are way below that. The second thing is from the standpoint of the Supreme Court verdict, I do think the administration has ample avenues through the different sections to re-put whatever if they want to. So I think there will be a knee-jerk reaction, but I would expect the markets to actually look through that because some of those tariffs that the administration wants to keep will come back through a different channel. So I'm not sure it actually changes the path from the broader fundamental perspective here.
Not even for Neeraj, hi morning, and wishing you a better 26. Happy 26. Good to see you. Not even for in a short-lived sort of near-term way for a badly hit market like India in terms of relief.
So I think there will be a near-term reaction. There certainly will be an immediate, as I said, knee-jerk on the back of the ruling you will see. From an India perspective, I'm in a more positive camp just by virtue of the changes we have seen, whether it's in terms of tax cuts flowing through some earning recovery that you would expect this year, as well as I would say the max tariff uncertainty behind us and the rupee seeing signs of stabilization. So I think India is a slightly broader discussion on what drives 2026 from a calendar year perspective. But from a tariff side, yes, it will see. But the broad tariff uncertainty around the trade deal, I think that still has to get out of the way.
Hi, Neeraj. Morning. Good to see you. Plenty of worries, right? Uncertainty on tariff. Don't know what Trump's going to do next. And now suddenly geopolitical issues again are creeping back up. How big a risk is that?
So there is obviously pockets of geopolitical uncertainty, but markets have been looking through it. To some extent, obviously, the markets have gotten a bit complacent because nothing is at an individual level that big. I do think the impact of that, even though you have a broad positive backdrop from a fiscal and monetary policy standpoint globally, is the geopolitics risk will lead to higher volatility in 2026, but not necessarily a turn in the market direction.
But just the knee-jerk reaction on the US markets, Neeraj, because on one hand, they will be losing the tariff revenue that they have collected so far, and it's quite sizable. There will be refunds, reimbursements to do. But on the flip side, it does open up global trade, the tensions between US and various other countries. So how will US markets react in the event of any sort of a strike down or a slowdown?
So I think it's obviously it varies by the asset class. It's negative for the treasury markets, the US rates, because obviously a part of the fiscal financing market moved towards calculating the tariffs as a part of the fiscal financing, which is running at around close to $2 trillion of deficit right now. And what are rate tariffs for the full year? And I think markets will reprice that, which means it's negative for the treasury markets. Equities will be mixed based on the sectors.
Yeah, I mean, what has happened so far, it's all upside down, right? Middle of last year, there was expectation that it's bad for growth, so hence bad for equities. None of that played out. And all of this is, equities are having a great time. So if this throws everything into a bit of a confusion, I guess it is bad for equities, near term at least. That's the... if something is going well and it gets interrupted, it changes direction for a little bit. But I guess long-term yields go up again. Because of those fiscal calculations, fiscal fears returning.
I do think the long-term yields go up. You will see potentially a further steepening of the US curve, which again, depending on the levels, is beyond a point is not great for risk assets if you see a significant backup in the long end of the curve. So to your point, I think the immediate reaction, the equities might be negative. And then you have obviously a mixed picture under the hood in terms of which sectors take a bigger hit based on the interest rate sensitivity.
Neeraj, is good conversation. It's a bit near-termish, but it's all near-termish right now. I hope you'll join us once we have the decision from the Supreme Court in terms of the shape, size, form on tariffs as it comes later tonight. Thank you very much for being here on CNBC TV18.
Thank you.
Okay, let me just quickly run you through the interactions which are lined up here on the program. 8:30, we discuss the government's plan to scrap curbs on Chinese firms bidding for government contracts. We have Prabhudas's Amit Anwani joining us for that. 8:40, management of P.N. Gadgil. A phenomenal run in some of these stocks, jewelry companies lately. 9 o'clock, we have Prabhu Sen of ICICI Securities. It's all been about oil, but more about oil politics more than anything else. But what are implications? Stocks have sold off. 9:20, Gautam Shah will talk technicals, charts with us. Markets, of course, in focus. 9:30, we have the big Bharat Coking Coal, the Coal India subsidiary IPO, which is opening for subscription. So we have the chief from BCCL and Coal India, both joining us to talk to us about that. 9:40, Yogesh Agarwal of HSBC India, head of the IT sector's third quarter earnings. Vikash Kumar Jain is the market conversation from CLSA, Outlook 26. And towards the end of the program, Lada speaks with Goldman Sachs' India economist Antanu Hussain Gupta on the just released GDP numbers on rates, rupee, and more.
Time to slip into a short break. Got a lot of stock-specific action to track for you. Get to that in just a bit in our special Top 10 segment. We look at ONGC, Oil India, Reliance Industries, BHEL, Power Grid, Astra Micro, Power Mech, Sagar Cements and Andhra Cement. They'll all be reacting to positive news flow. While on the flip side, you have Elecon Engineering that will be reacting to negative news flow. Take that break, come back, into further detail on all of these names.
Welcome back. Let's get the GIFT Nifty up for you on the screen. In the last 4 trading sessions, the Nifty's lost 470 points, 4 consecutive sessions of losses, and we closed below the 25,900. And this morning, there isn't any big recovery afoot, at least for now. 1.7% lower on the benchmark indices this week. Our research team is standing by with CNBC-TV18's list of top stocks for the day. And big moves seen in crude prices. Brent crude is at $62.50. So Sonal is joining in now to tell us the impact that we could see on some of these oil and gas names.
Good morning, Rima. Well, we've been seeing a lot of volatility, but Nifty Oil and Gas, that index is down 6% in last 1 week itself. Oil prices overnight rose 3%. There have been a lot of focus on Venezuela, what happens with supply in Russia. Now, there are talks of more sanctions, Iraq and Iran as well. On the back of that, crude prices surged overnight, and this has come in after 2 days of minor declines that we saw as well. Jefferies has put out a note today that they say despite all that is happening globally, the market is still oversupplied by 2 million barrels per day. And by the end of calendar year 2026, it is projected to rise to 3.5 million barrel per day. So yes, the crude rise is good for Oil India and ONGC, but we'll have to see whether that continues or not. Additionally, Reliance is in focus because they put out a statement that they're awaiting clarity on access for Venezuelan oil by non-US buyers, and they will consider buying the oil in a compliant manner. If that does happen, it could be positive because Jefferies last week had indicated that the company earlier used to buy 20% of their oil needs from Venezuela, and if they continue to do so, it could be at a $5 to $8 per barrel discount, which will aid their GRMs. So these stocks will be on our radar today.
Okay, all right. Thanks a lot for that, Sonal. Hopping across to Vinny. She's here to tell us some stocks in the news. Vinny?
Hi, good morning. So talking about some of the order wins that have come in, one is BHEL. Now they've received an order for around 5,400 crores. This is from Bharat Coal Gasification Chemicals Company, which is a joint venture that they have with Coal India. BHEL is one of those promoters of this company. They have 49% stake as well. And obviously this is a related party transaction. It's taken place at an arm's length price. And the project has to be completed in 42 months. Other than that, they have operation and maintenance service contract with them as well, which will be for a period of 5 years. So an important order there for BHEL. Powermac, that's the next one. They've been awarded a BESS order from West Bengal State Electricity Distribution Company. This is overall 1 gigawatt BES, and additional there's a green shoe option of 1 more gigawatt. So totally, including the green shoe option, the revenue potential would be 3,126 crores. Excluding it, it is around 1,500 crores. Lastly, we have Power Grid also. They have been declared as a successful bidder to establish interstate transmission system in Karnataka. This is a project of a 400 kilowatt of DC transmission line. All these stocks are going to see some bit of a green because of the order wins today.
Thank you very much for that. BHEL was down more than 10% yesterday, but that overhang on allowing Chinese imports in the sectors that they operate, which could increase market competition, still looms on that. But moving on to Ria on Astra Micro. Ria?
Well, good morning. Astra Micro has received an order today. In fact, the JV company called Astra Rafael Comsys has received this order worth roughly 275 crores from the IAF for the integration and installation of software in aircraft. Now, this includes the integration of software-defined radios on MiG-29 aircraft, as well as the installation of network-centric application on MiG-29. And this also includes the procurement of 24 SDRs for the LCA Mark 1A aircraft as well. The execution period for this will be 12 months. Just looking at the order book status for Astra Micro as a whole, at the end of quarter 2 of FY26, the standalone order book was roughly 1,900 crores. And going forward for FY26, the company is targeting 15 to 20% revenue growth. And in quarter 3, they are expecting an order inflow of in excess of 400 crores. And for quarter 4, they are expecting the order inflow to cross 600 crores.
Thank you very much for that. Elecon Engineering's Q3 numbers. Vinny, how did they look?
Q3 numbers not that good, right? Revenue saw only a growth of around 4.3% on a year-on basis, coming in at around 550 crores. EBITDA is down by 23%. Margins have seen a sharp contraction, 19.8% versus 26.9% last year. Profits are down by 33% as well. Even segment-wise, the transmission segment, that's seen a very muted growth of just around 1.5%. And material handling equipment, that saw a better growth of 21%. But transmission division, that's a higher portion in terms of the total revenue. Now, order book, that that came in at around 1,372 crores. The company has maintained its FY26 guidance, which that's spoken about. Actually, slight bit of a reduction there is what they've done. They've lowered it by up to 5% in terms of revenue guidance. Adjusted EBITDA margins may be lower up to 2%, around 2% is what the company has mentioned in their PPT. They said that overall order book is healthy, but yes, as of now in terms of revenue as well as adjusted EBITDA could be slightly lower. Margins obviously this time mainly were impacted because revenue was one flat. Other than that, increase in employee costs as well as change in product mix overall impacted the margin. So we could see some bit of a red coming in for Elcon Engineering.
Got it. Thanks a lot for that, Vinny. Well, I'm looking at two cement companies. There is Sagar Cement, which is the parent of Andhra Cement. Now, yesterday, post-market hours, they have disclosed on exchanges that they're looking to sell close to an 8% stake that they hold in Andhra Cement. That's around 75 lakh shares. But via this, they'll be able to raise close to around 54 crore rupees. Sagar Cement, what's good for them? Well, they'll get close to around 55 crores or thereabouts for this 8% stake. And they still will have another 6% to come down to that 75% odd level. For Andhra Cement, interesting because yesterday the stock closed at around 69 rupees, but the pricing that they have come in at a base price of around 72 rupees. So because it's at a bit of a premium, going with green on both these two stocks, Sagar gets some money. The OFS is priced at at a bit of a premium to yesterday's close. For non-retail investors, well, that opens up today. While for retail, it'll open up on Monday itself. The reason that Sagar Cement is doing this is because currently the holding is 90%. It needs to come down to 75%, and they'll be looking to fulfill that. My gut is that they get it done in the next 1 month or so, come down to 75%. Post this OFS, it'll be at around 81% or thereabouts. So we'll keep an eye out on both these two stocks, moving with a tinge of green on both of them.
All right, let's quickly recap then. The top stocks on our radar, stocks with positive news flow are ONGC, Oil India, Reliance Industries, BHEL, Power Grid, Astra Microwave, Power Mech, Sagar Cement and Andhra Cement. Stocks with negative news flow are Elcon Engineering. And keep your eye on oil marketing companies too, with the rise seen in crude prices. In fact, Manisha is now joining in, talking about crude to get us all the action that's happening in the world of commodities. Manisha, big news on crude overnight.
Oh, yes. It's trading at a 2-week highs right now, and the crude prices have gained up by nearly 4% in the overnight markets. With this, we are heading for a third weekly gain. This is after crude closed 2025 down by 18%. So January, in that sense, has started on a positive note for the markets. It is about investors assessing developments in Venezuela. Reports of Chevron, ConocoPhillips, and Exxon are expected to play constructive roles in Venezuela. And it's not just about Venezuela, because there are supply concerns also coming in from Russia, from Iraq, from Iran as well. The only reason that the markets have not run up has been because 2026 crude surplus is estimated anywhere between 500,000 to 3.5 million barrels per day going forward every single day. So that is what seems to be bothering the markets right now. With the gain in the crude prices, we also have seen support come in for the crude products. So whether it's about natural gas, heating oil, gasoline, we've seen a gain come across energy basket in the overnight markets therein.
Okay, all right. Thanks a lot for that, Manisha. For the time being, though, we'll slip into a short break. On the other side, we have PL Capital's Amit Anbani, who's waiting by to help us analyze the reports that suggest the government plans to scrap curbs on Chinese firms bidding for government contracts. Stay tuned to that conversation.
Welcome back. There is some significant information that is coming through on Vodafone Idea, where Vodafone Idea has disclosed to the exchanges about the relief on AGR. They're saying the AGR dues from FY7 to FY19 has been frozen. Just trying to get those numbers up for you on your screen. The AGR dues as of 31st December 2025 are frozen. And payable as follows: a maximum of 124 crore and to be paid annually over the next 6 years. So that is not significant. 124 crore is what the company needs to pay. 100 crore annually over the next 4 years thereafter. March 2032 to March 2035. And after that, from March 2036 to March 2041, the remaining AGR dues have to be paid. So basically, in a nutshell, for the next 10 years, the company does not have to pay much by way of AGR dues. Otherwise, the AGR dues were very sizable, exceeding more than 30,000 crore rupees on an annual basis. The company's cash flow did not support that. And now the company is saying that they've received official communication from the cabinet. Ashmit has been telling us that how on 31st of December, which was the last, the cabinet made in the last trading day of, 2025, the cabinet had met and they had discussed the relief for Vodafone Idea. So now the takeaway is that for the next 6 years, the company has to pay 124 crore. After that, for the next 4 years thereafter, the company has to pay 100 crore on an annual basis. So next 10 years, the outflow from the company, the cash outflow, will be actually quite negligible. Thereafter, the company has to make good its payments. We'll try and connect with an analyst, but it does seem like at least for the next 10 years, there is sizable relief for Vodafone Idea, and we wait to see how the market connects. So this is official communication, what has come through, and it is a big relief for almost 10 years now. And we'll wait by to see if this leads to the debt funding that has been on hold in abeyance because of lack of clarity on the kind of relief that the company is going to get. So the company was seeking to raise some debt, which will help in kickstarting its capex plan in full gusto. So, FPO money fundraise was done around the same price of about 11 rupees, but the company wanted to also additionally raise money, 20,000 crore via debt. And now with this official release, the official communication coming in from the government, let's see whether the company and the bankers can get that debt funding in place. So important relief coming in for Vodafone Idea.
Got that, Rima. We'll let you ponder on the numbers a little bit more. For the time being, let's turn our attention from telecom to the capital goods sector. Well, that's in focus. A Reuters report suggests that the government is planning to scrap a 5-year-old restriction on Chinese firms bidding for government contracts. Vinny joins us first to set things up, and then we go across to Amit and Vani. Vinny?
Hi. So yes, absolutely. Yesterday we had this report that came in from Reuters. Like you mentioned, the Finance Ministry is planning to scrap that 5-year-old restriction on Chinese firms. This restriction was placed in 2020 on power, railway and other sensitive contracts. These are government contracts. So yesterday we saw all these stocks fall in trade. Now, obviously, what came in today as an update furthermore, brokerages seem more divided in terms of the timelines, actual implementation if this actually takes place, and given that these are sensitive sectors that are involved in this contracts for the government contract. Now, what is the view for Bernstein? Bernstein said the relaxation may be more segment-based with prior requirements on part of Chinese firms, so approval coming on that front, but more segment-wise. They said the negative impact could come in for players like L&T, equipment players, while beneficiaries of this, if actually takes place, then they would include asset owners like Power Grid and NTPC. What is Jefferies' view? They said the highest impact, if this actually takes place, would come in for BHEL, L&T, Afcons, ABB as well as CG Power, while lowest impact would be defense companies followed by Cummins. Other than that, we have impact that came in on T&D companies also is what Jefferies is highlighting. So we could see impact on Siemens Energy as well as Hitachi Energy. What is IIFL's view? They said that the Chinese company TBEA is likely to participate in Power Grid's tenders for these reactors, and restriction will be on a case-to-case basis, and other specific products will be specifically mentioned, not for everything as a whole. It will be case-to-case basis. Phillip Capital is saying that Chinese players have mostly kept out of these grid, railways as well as metro signaling tenders, and headline policy has created uncertainties. Obviously, that could weigh on sector valuation in the near term. Even Macquarie is saying that this move will help supply chain constraints in import as well as dependent critical equipment speed up project execution, as well as lifting these import curbs will be gradual and calculated. ICI Securities is saying that easing will allow Chinese companies to set up factories in India and compete as well. So quite a divided view coming in, but important to see if this actually comes through. But impact surely comes in for some of these players in this industrial sector.
Thank you very much for that. We saw the impact yesterday as well, 3 to 10% lower on many of the stocks. Amit Anvani, research analyst at PL Capital, is now joining in. Amit, give us your analysis. If this does come through, who would benefit and who would be negatively impacted? Break it down sector by sector and by how much?
Yeah, thank you so much. Good morning. So I think this is the analysis, and if at all this comes, there's a lot of clarity which is required. But if I just throw some light pre-2020, there's a lot of probably orders, imports raised by the private sector and the utility side to these private, the Chinese companies, including Shanghai Electric, got order from Reliance Power, and there were a few notable orders in this space. If you also notice, there was a period when there was kind of 50% of all the capacities were coming from the private sector, which went into tailspin during 19 to 22 period. And if I really see the data after 2020, the private sector is literally kind of narrowed down in terms of the new capacity addition. And considering that this is highly vulnerable sector in terms of critical technologies where government may not really allow the blanket entry of Chinese firms. So one really have to understand, but if at all this happens, then there's also a notable, data that the NTPC orders typically do not install the Chinese BTGs. So if I see that the government sector is probably much higher in terms of proportion versus pre-2020, I think the scope should be, as you said, in some kind of requirements and very specific where we might be facing serious challenge in terms of execution, and probably it should not be a blanket. But if this happens, obviously BHEL is something which is very prominent in this space, and this market has a limited supply. L&T, BHEL, and few guys are supplying this already massive tenders which has been raised in past 2 years. So probably that is one area where this can happen. In terms of transmission space, we saw impact yesterday happening to many firms, including ABB, Siemens. So obviously few firms did highlight it in their commentaries, including ABB, that if there's some relaxation, there could be possibly an impact on the margins. But I think my understanding is that in terms of impact, there's been a massive capacity creation and capex done by the sector. So I really doubt that it will be a direct blanket entry in this space. And we're talking about at least 40 to 50% capacity addition in the sector over the next 2 years. And even when this notification came in 2020, and reports suggest that the decline was only 25% post 2020, which indicates that the Chinese imports were still happening at the lower end, and except the critical and strategic areas where government was really concerned. So I think we have to really understand in what form this is going to come. But I'm pretty sure the government has been focusing a lot in terms of localization and this massive domestic capacity creation which is happening. I'm really doubting the scale at which this can come. Yeah.
Okay, all right. Hi, Amit. Good to see you, and thanks for a quick insight out there. But do you think the worst case scenario plays out? How would you approach a stock like BHEL? Yesterday, the stock was down 10%. What's your view?
Right. So if you see BHEL, in terms of ordering, past 2.5 years has been massive. There's been a massive addition in terms of order book, which is over 2 lakhs. So I think the key area to look for BHEL is really to ramp up the execution, where now they have the book, and execution, margins, and health of the balance sheet will be in key focus. And they were already, we were talking about that the orders in proportion they came in past 2 financial years probably have peaked out, and even going forward, there could be some moderation once probably in next 12 months, whatever order comes in versus F24, F25. So definitely BHEL might have some impact if there's anything coming on BTG. They have been quite, active in this space in terms of order inflows. But I think in near term for me, what is also equally important is they have already had a very strong order book in last 24 months. The market is looking for execution, margins, and health of the balance sheet also in case of BHEL.
Amit, which segment is, if this comes through, this China bit, right? More supplies from China. For which sector is the most? It's power, right? Which is most impacted?
Yeah. So if you see, I think the duration when it came, we were talking about Chinese spying and Chinese control on critical power assets. And that led government to, along with the China clashes which happened that time, that led government to take this step. So I think apart from power, it was telecom and few other sectors where this was also probably implemented. So I think the strategic sectors again will be kept out of the ambit. And my understanding probably could be at the lower end of, let's say, transformer or other transmission sector products, which are probably not highly strategic, which we're already seeing.
So there has to be, Amit, in your opinion, there has to be specific notification to this regard, right?
Absolutely.
And
yes.
we don't have that yet. I mean, so...
Yes. It's
so
just
we are talking in the realm of possibility in that sense. Because for BHEL and all, I remember back in the day, in the in the early 2000s, right? Chinese imports were a big bane for them because there used to be boilers, etc. used to be much cheaper, right? And that used to be tracked very closely. And of course, I mean, the power sector went into a funk in the 2010s. So there wasn't that much chatter. But if it's coming back and now Chinese imports are also back, then it'll probably need to be watched. But isn't it, you said only strategic sectors will be kept out. But what is strategic? Strategic is defense, right? You'll have, there is power generation mainly, EMS, there could be renewables. These are all areas where China is a big producer.
Yeah, so strategic plus sectors where government sees any security concern, which was notable when this notification came, and particularly to BHEL, as I said, the sector has changed. So pre-2020, there was a lot of private orders and there was a lot of private ordering going to this Chinese firms. So I think now that scenario has changed. There are a lot of government plus state orders which are there when we speak in past 24 months. And it has been very rare that they have ordered to the Chinese firms. So that's why I said there's many questions around this, and the exact quantum probably once all this unfolds will make it more clear.
Okay, thank you very much for that. Just a thought, is there any geopolitical angle to it? I guess, maybe India is creating a strategic hedge, maybe by aligning with China, but will it complicate, if it's easing ties with Beijing, but will it complicate our trade relations and negotiations with US by doing it?
That's second order, third order implications. But I think it's not as if you're replacing US equipment, right? Yeah. I mean, especially in these sectors, larger messaging, will it sour ties? Who knows? But specifically with this regard, I mean, to buy stuff to import stuff from US, comparatively does not make sense. The other bit which we want to talk about, of course, is there are two things now leading up to 9:15 we want to talk about. One is, of course, Vodafone Idea in a bit more detail. And the other is IEX, which should also be in focus because there is the hearing today. And we'll talk about both Voda Idea, some perspective on this in terms of what it means, and IEX as well in a bit. Okay, I think let's actually bring in Ashmit, who's now with us, to just run us through the contours of what's at stake. Where did we leave off first off last time? Because that day stock was up almost 10% by close. And will we get a ruling today? Ashmit, take it away.
Well, the APTEL is all set for a hearing in the IEX case, the Indian Energy Exchange's challenge to the coupling order that had been passed by the CERC in 2025. Now, a large part of the hearings we've seen a lot of back and forth with essentially the exchanges alleging that this entire order, this entire exercise is tainted. The exchanges have been citing a SEBI report which suggests that this coupling order was nothing but, in fact, a ruse, a scheme, an insider trading ring which led to illegal gains of over 170 crore rupees in the hands of CERC officials. They point out that the very author of the coupling order is, in fact, mentioned in the SEBI report. Now, this was also taken note of by the APTEL. The APTEL said that the theatrics, the drama with which this order was passed, has raised questions in the minds of the judges, and also going on to say that if there is foul play found, APTEL will not be shy of taking action. On the back of all of this, we had a very interesting revelation by the CERC lawyer. The CERC lawyer said that they wanted this entire exercise to be fair, to be transparent, to be consultative, and that keeping that in mind, they are now going to get a formal opinion from the Commission on whether the coupling order can be withdrawn. Now, this is critical. Now, just this comment from the lawyer led to a nearly 12-13% spike as far as the IEX share prices are concerned. We're yet to get clarity whether the Commission has decided to withdraw its coupling order. We'll get clarity in just moments from now when the APTEL takes up this case for further hearing.
Got that, Ashmit. We'll stay tuned and we'll come across to you for that, the outcome of that hearing. Stock has ended mildly lower, but as Ashmit said, had spiked up big time early this week. Take a short break, come back. Our technical experts will be waiting for us. Don't go anywhere. Welcome back. It's that part of the show when Hormuz joins us to tell us about some big movers yesterday, those backed with volumes and some with delivery as well. Hormuz, take it away.
Morning, Nigel. And yesterday's theme over the last hour or so were the capital goods names that saw a very, very sharp sell-off in those final few minutes of the trading session, be it BHEL, ABB, L&T, Siemens, all of them seeing losses of anywhere up to 11% for BHEL. And if you take a look at the volumes as well, significantly higher in comparison to its 20-day average. BHEL had close to 5 crore shares that were traded. ABB had 7 lakh. Siemens also had around 6 lakh shares traded. All of them were higher than their 20-day average. But the delivery volumes, though, for BHEL, out of those 5 crore shares traded, 1.5 crore were marked for delivery in terms of the delivery-based selling. For ABB as well, around 3 lakh shares were marked for delivery. And for Siemens as well, almost close to 3 lakh shares were marked for delivery. So anywhere between 40 to 50% of the trading volumes were marked for delivery on these capital goods names. TCS was one such name that was underperforming right from the start of the session, even before the sell-off began towards the later part of the day. And it was among the top contributors to the Nifty fall. Volumes on Thursday were the highest in a month. We saw delivery-based selling worth over 750 crore yesterday. 42 lakh shares were traded. The 20-day average of 20 lakh shares, so around 2x its 20-day average. And on the delivery front as well, 23 lakh shares marked for delivery, twice the 20-day average of around 12.5 lakh shares. And the stock is now back to its very important support levels, which is at around 3,200 rupees. And lastly, the exporter names, Gokaldas, Avanti Feeds, Apex Frozen, all of them seeing losses of anywhere between 8 to 9% yesterday. Backed by volumes, yes, because the volumes were higher. Not so for a lot of those shrimp feed names, because Apex Frozen's volumes were less than its 20-day average, but the delivery volumes were higher in comparison to the 20-day average. So Gokaldas fell on strong volumes, but the other two had not so significant volumes despite the fall that they saw in yesterday's trading session.
Got it. All right. Thanks a lot for that, Hormuz. Slip into a short break. Come back, pre-open rates. We'll have our technical experts and also Prabal Sain of ICICI Securities will be joining in to analyze the impact of crude oil prices as the geopolitical issues rise. Stay with us.
Okay, welcome back. I think, 3 minutes to go for the pre-open session, so just about kicking off things. Shrikant Chauhan of Kotak is with us. Mitesh Thakkar of Bonanza is with us as well. Gentlemen, morning. Good to have both of you here. Near-term moving averages broken. General kind of gloomy mood all around. Mitesh, what would you do this Friday?
Morning, Prashant. So I think, yes, there is some negative in the sense that we have kind of broken below the short-term averages, but the support pivot of 25,850, 900 is still holding out. Two, I think the PCR is now getting close to the level from where typically markets see a rebound. So I think it's around 0.67 or 0.66. And therefore, there could be some respite in the short term. So markets, the structure is weakened, slowly, turning slightly negative, but we may not be looking at a big immediate drop. It can be a case of a pullback to about 25,950, 26,000. If we fail to sustain above that, then I think we should come back and retest possibly 25,750 to begin with, and then maybe slightly lower levels.
Okay, got it. Got it, Mitesh. Shrikant, coming across to you. how are you feeling about the markets? Yesterday's clearly the blow was not great at all from a bullish perspective, but there's no signs of recovery. But a couple of technical indicators will give hope. Your view?
Good morning, Nigel. Good morning, Prashant and Rima, everyone. So for Nifty, yes, it has broken its all important levels. We were of the view that 26,000, 25,900 should be the next major support, and there the market should halt. But it has broken that level and it closed below the same. So which clearly indicates that now the market has changed its trading range in the short term, and any pullback close to 26,000 will be an opportunity to reduce some long positions, because I'm of the view that the market will take some time to rebound from lower levels. And on the downside, we may see the levels of 25,600 or maybe 25,500 in the worst case scenario. So now the range has changed from 26,300, 25,900 to 26,100 and 25,500 on the downside.
Got it. All right. Let's get to individual stocks then. Mitesh, coming across to you. What do you have for us on this Friday morning?
Yeah. So today I have a mix of buy and sell calls, 2 buys and 2 sells. On the buying side is Havells, which I would recommend buying. Mine dips at 5-7 points lower from the closing price, around 14.75. Buy with a stop at 14.50 for targets of 15.25. Then a buy on Apollo Hospitals with a stop below 7,300 for targets of around 7,500. 2 sell calls. One is Suzlon, which is a sell with a stop at about 52.5 for targets of 48, and Indian Hotels is the next stock, which could possibly see some more price decline. So keep a target of 680 and a stop at about 716.
Shrikant, what about you?
The overall breadth of the market is extremely poor. And whenever we see such type of activity, I mean to say extreme oversold sort of activity, we see some rebound in the market. And in that case, we can expect rebound in stocks like Lupin Laboratories or I can say IDFC First Bank. There we can see furthermore upward activity. For IDFC First Bank, we are of the view that it is heading for the levels of 90.91. We can keep a stop loss at 84.50 for the same. The other stock on which we discussed, Lupin Laboratories, there also we are of the view that it is heading towards the levels of 22.50 at current levels, or on dip around 21.80. It's a buy with a stop loss at 21.60 on the downside. 2 stocks have broken their important levels, like Keynes Technology as well as Trent. Keynes has broken its important level at 3,800. The next level to watch out for would be 3550, 3500. So there we need to be careful, and we should look for, in fact, adding some short positions at current levels. For Trent, it has broken the important level at 4,000. It closed below the same. So the next level to watch out for would be 3,800 or 3,750.
Got that. Thank you very much. We will track some of these calls from both Mitesh and Shrikant, and we'll have them back on a little later. Okay, the rupee is at about 89.87 compared to yesterday's close of 90.1. Equity market, though, I think, although pre-open has started, is not showing up in any significant way, but there is some strength in the dollar rupee. So 0.8 lower. Let's wait. I mean, it's just 2 minutes or so as far as the pre-open session is concerned. Well, a spotlight in the oil and gas space as geopolitical tensions are rising. Prabal Sen is energy analyst at ICICI Securities. He's with us. Prabal, good morning. Great to have you with us here. Thank you for joining us. Oil is at the center of all of it, and not just oil prices, but oil politics, Prabal. And of course, what rattled markets was this entire up to 500% threat in that bill, which of course has to be cleared by the US Parliament, etc. I don't know how long that will take, but apparently it's bipartisan support for the bill. What is your sense? I mean, has that come up as a big point of worry from investors when you speak to them, Prabal?
Absolutely. I think the last couple of sessions has clearly showed up that, this concern is obviously something that is worrying investors. Frankly, very difficult to take a call today on what exactly the tariff would be or what the actions are going to be of, the companies with respect to their Russia sourcing. The extent of Russian crude that is being sourced by players like Reliance, as per their official pronouncements, is close to nil. Even HPCL in its Q2 briefing did mention that Russian crude had come down very drastically to less than 10% of its overall requirements. And obviously, what this move will spur probably is a reduction to even lower levels or maybe to even negligible levels going forward. In any case, I think what is of important is that the discount that Russian crude was actually getting effectively after accounting for all the additional costs that are involved today in importing Russian crude, that discount had anyways come down to about $3 to $4 from what we understand. That is at least what the companies have been briefing in the last couple of quarters. So from a numbers perspective, the elimination of Russian crude is not necessarily going to impact the GRMs to a huge extent. Whether the sourcing can be reduced drastically and whether alternate sources can be found quickly enough that no disruption occurs in refining throughputs is something that I think we'll have to sort of wait and watch at this point of time. But on the face of it, prima facie, as a sentiment, obviously, if actions are taken, that will be a negative.
On a numbers basis, Prabal, as you said, right, doesn't make that much of a difference anymore. But that is the other point, which is kind of unknowable. It may not all be about just numbers, right? The point is that Russian oil, China is a big buyer. We've been buyers. And India, Russia have long-standing ties. So if you cut off and stop buying Russian oil, I mean, there's a 50, 60-year history, right? I mean, and Russia is embattled and all of that stuff, right? So I'm sure all that, it's not just the numbers, not just about the $2-3 discount that you're able to buy oil at. Would you agree?
I would leave the discussion on the political implications to people who are better qualified. I can only comment on what the impact is going to be in terms of the companies that we track. I don't want to, necessarily comment on what this would mean from a geopolitical perspective. The issue really is that if you look at the Brent movement also, I think the concern really is that if all of the Russian crude that is still finding its way to the markets actually goes out, then suddenly the huge amount of supply surplus that people have been projecting, that actually does tighten a lot. So from a demand supply perspective also, taking out the entirety of Russian crude from the markets, I don't even know whether that is practical or that will eventually happen. But if a significant chunk of what is being imported, about 0.3 to 0.4 million barrels probably still finds its way, rather 1.2 to 1.3 million barrels still was finding its way to India, and probably much more was going to Russia. So if that is sort of
Let's go to China.
Yeah, China was obviously more than that. So elimination of that kind of volume will have a huge impact. The entire supply surplus that people have been talking about can go away if Russian crude is entirely blocked. As I said, I don't know if that is even practically possible, but I think that is the fear that is there in the markets. Whether politically, how India handles its relationship with Russia, that is out of my purview, I'm afraid. I don't want to comment on that.
Yeah, it's all geopolitics now, isn't it, Prabal? So maybe we need to become oil plus geopolitics. I mean, one more beat to track.
That has always been the case, but yeah, unless we can write officially on it, I wouldn't want to comment.
I know. You said it practically possible. You don't mean... I mean, the decision to do it, if it comes to that, is I'm assuming in the manner of speaking, a 30-second decision, right? I mean, everything after you've gone through everything, which after you take... So what you mean by practically is whether, I mean, all those factors align to be able for the government to take that decision.
If I can interject, what I mean is very simply, Russia exports close to about, even today, probably exports close to about 5 million barrels of oil per day, right? 4 to 5 million barrels. Taking out 4.5 to 5 million barrels of supply from the global markets, despite all what you have heard in terms of supply surplus, is just not feasible. If you look at most estimates of the excess supply that is there in the market, and I'm right now building on basis of what OPEC is producing currently, yes, they can maybe over a period of time bring an additional even 2 to 3 million barrels a day of supply that they've held back. But barring that, today to take out 5 million barrels is simply not feasible because your surplus itself is not really more than 1.5 million barrels, depending on who you ask. So how do you actually manage that without bringing in additional supply from anywhere else? Whether Venezuela can fill the gap somewhere down the line, that's a different question. In the immediate term, what can be brought on stream from Venezuela, even if all the blockade is removed and sanctions are loosened, is hardly about 0.2 to 0.3 million barrels a day, based on whatever we read. Get it above that requires a significant amount of investment over a decade to really bring meaningful supplies back from Venezuela. It's not one-on-one.
Your interaction suggests we are still getting about a million plus odd barrels out of our 5 million imports every day.
I think if we look at the percentages that have been mentioned in the 2Q briefings by the OMCs and some of the other players, it is about 20% of our portfolio of imports is probably still 15 to 20% is still being met by Russia. So if you look at our overall imports of 4.5 million barrels a day, that would translate to something around 0.9 to 1.1, 1.2 million barrels. That's what I'm basing. There's no definitive data.
Got it. This entire, the other point is Venezuelan crude, right? I mean, back in the day, Reliance used to be a very large importer before all of this, of course, right? I think it used to be at one point the single largest buyer of Venezuelan oil, and I think they've said that provided they comply with all rules, regulations, etc., they'd be happy to receive oil shipments from Venezuela. You think? How do you read that development from a company-specific perspective?
So, from Reliance's perspective, Reliance is one of the few refineries that are in Asia that are capable of processing the kind of heavy oil that is there in most of Venezuela's production portfolio. If they can actually manage to start obtaining that heavy oil, that does two things. One, of course, it fills the gap that may open up if Russian crude has to be eliminated. And two, obviously the heavy light spread in Asia, I think, is probably going to widen. And that is obviously good news for any refinery in India that can manage to procure this heavy oil. The challenge for Venezuela, however, is that to actually be able to make it possible enough to even export it through pipelines, you need a large amount of diluents, what are called. You need to dilute the kind of oil that it comes using naphtha or other elements, which also are in short supply. So even to ramp up heavy oil exports, there needs to be some work that needs to happen. And, as of now, we have no clarity. But any crude that starts to flow from Venezuela to Asia, Indian refiners are actually some of the few that are there in the region that can actually process these heavy oils, including Nayara and Reliance, of course.
And yeah, no, absolutely. Thanks very much, Prabal. It's an interesting conversation, and thank you for joining us here this morning on CNBC-TV18. Well, 9:10 calls. Mitesh is with us. Mitesh, what do you have?
I'll go with the sell on Suzlon for targets of around 48.
Okay. Suzlon, a sell on Suzlon. Is Mitesh's call right now. Well, what are the brokerages saying? What are the top calls, ideas? Sud has gone through a lot of them. So, what do you have?
So I have on NHPC, CLSA maintains high conviction outperform with a target price of 117 per share. It believes that 2026 should transform NHPC's size of capacity and it should increase by 64% and can see visibility of 90% EPS growth over FY 25-27. It has also mentioned few catalysts. First, final tariff of its Parvati 2 project. Second, full commissioning of Subhasnari Tower Hydro project by Q4 of FY 26 and award of 4 hydro projects and 1 pump storage in 2026, and these 4 hydro projects to improve visibility of growth in FY26 as per CLSA. Next one, Macquarie has written on hospitals. It says Apollo and Max Health have lagged Nifty 50 performance by 14% in 2025 and expect more consensus earnings downgrades to weigh on the stocks in 2026. And the 8 listed hospitals chains guided to add more than 6,000 beds before the end of FY27. That's the largest annual capacity addition in the last 8 years. So EBITDA drag from new hospitals is not reflected in current consensus estimates, and Macquarie maintains underperform rating on both these names, Apollo Hospitals and Max Health.
Thank you very much for that. Sonal joins in on Petronet.
We did see a note 2 days back on Petronet about a possible regulatory risk. Today, there is a note where the stock has been upgraded by JP Morgan to an overweight. The target price has been raised to 335 rupees a share. They expect the earnings momentum to become better on a couple of reasons. Better volumes because of the expansion that's happening in Dahej in March. They're expecting a 5% tariff escalation in terms of their transmission and lower impairment costs, which would come by in this quarter and the following quarters as well. all of this would lead to better earnings or consensus estimates rising in FY28 as well. But yes, there's a potential of renegotiation of the Dahej tariffs, the risk from the large petrochemical complex that the company had spoken about earlier. These are some of the key valuation issues according to JP Morgan, but these are something that would continue for a bit and they will remain unresolved for a couple of quarters. But better earnings are something that should be watched out for Petronet LNG. That could keep stock higher. That's the word coming in from JP Morgan.
Thank you very much for that. Just quickly pull up Vodafone Idea, that's one. And the other one is Indus Stars, because the relief for Vodafone Idea is fairly sizable. The key takeaway is for the next 10 years, the cash outflow on the back of the AGR burden is very, very light. It's 124 crore each for the next 6 years, followed by 100 crore for the next 4 years. So at least for the next 10 years, till FY35, the outgo for Vodafone Idea is very, very less compared to what it would have been in the absence of any sort of a relief. And it's a long 10-year period. Earlier, the market was speculating it could be 5 years, which the street said perhaps is too short for a turnaround in Vodafone Idea. But this is a long rope of 10 years, gives the company ample breathing space. So that's the key takeaway, a lot of breathing space on the cash flow. And it's a long 10-year period. Secondly, as of now at least, there is no reassessment, no liability reduction. But the release says the committee is constructed to reassess the dues whose decision will be final. And I think that is important because if we finally get a decision on AGR, no more court battles, no more AGR overhang, it will be important for the company. So Vodafone Idea and Indus Towers should be on your radar.
Absolutely. 6% higher on Voda and 4%, 5% on Indus Tower at this point in time. What do we have? First rate starting to come through. The Nifty is absolutely flat, 25,884. So at least in the green, right? For what it's worth. Small mercies. So the Nifty Bank is absolutely flat as well. The mid-cap index is up about 0.25%. The small-cap index will come up as well. And I think there as well is going to be pressure, about 25 odd points lower, 0.18% in the red, 0.25% lower at this stage. So it's a tentative start, but it's let's see if you're able to claw back to the 20-day on the Nifty at some point during the day. But there's so many unknowables, and all of it, of course, hit us only after markets close here. So the only chance to respond to all of that, what will happen later today, is going to be on Monday morning. But ONGC, Power Grid, BEL, Asian Paints are some of the gainers up there. On the downside, you've got ICICI Bank, Adani Ports, Apollo Hospitals, which are starting lower. And I think it's a clean split right down the middle, about 25 up and 25 down, maybe a little more. Gainers outnumbering declines a little bit more on the Nifty. 20 points now on the index. Rima.
Well, BEL is your top gainer, up 1.5%. So rearmament defense is a big theme globally, and that is playing out in India as well. And particularly in the case of BEL, there is also an order win. So that's keeping the stock excited. On the oil and gas front, you've got strength in ONGC. We should pull up some of these oil marketing companies because they could be negatively impacted on the back of the increase in crude oil prices. And Reliance Industries has lost 7.5% in the last 4 trading sessions. And today, Reliance Industries has opened up absolutely flat. But ONGC is seeing some green on the back of a rise in crude prices. IT is also making a bit of a bounce back. TCS was the one which got punished yesterday with a 2.5% fall. Maybe the street was fearing some weak numbers come Monday. Stock has bounced back, but along with that, HCL Tech and Infosys both have a gain of nearly 1%. L&T also deserves mention because that got hit quite sharply yesterday. I think L&T was also down nearly about 3.5%. But there was this note which Bernstein came which said that the fall in L&T was actually a bit of an overreaction because they got a minimal benefit from the 2020 ban. And the Bernstein note also went on to say that only 5 to 6% of L&T's total EBITDA is directly vulnerable to Chinese competition. So the Bernstein report argued that the market reaction in L&T when the stock was down 3-4% could be an overreaction. And today you are seeing some green on L&T. Pull up a BHEL, a Thermax, and the other capital good names. So on the way up, we spoke about BEL, we spoke about L&T, IT names, Power Grid, Asian Paints is some green to begin trade with. Bharti Airtel there is a recovery across all the telecom names. Vodafone Idea emerges stronger, and maybe the street will watch for any sort of a hike in the tariffs. On the way down, ICICI Bank is correcting a tad bit. It's had a fantastic run-up over the last 4 days, outperforming all the other large banks. So ICICI Bank is down. And you've got some red when it comes to NTPC, Max Healthcare, Ultratech Cement too, but just down about 0.5%.
Well, Petronet LNG, that's one of the frontline names that's doing well. Sonal just told us about, Sudarshan told us actually about JP Morgan. They've gone ahead and they've upgraded the stock to overweight. They've raised the target price to 335. So that's clearly exciting. The stock up close to around 3%. Top volume winners out there. Nalco, well, that's pulled back a little bit. Remember, yesterday's trading session, most of the metal stocks were under pressure. But if this bull run is still there, for metals from year on, which has been a consensus call, then maybe these stocks could see a recovery after yesterday's dropping that we saw. So you have Nalco up, Hindustan Copper as well, which is higher in today's trading session. What's down? Elcon Engineering posted its numbers. Slam dunk, stock down 10%. You have, transformers and rectifiers as well. The stock actually had started off in the red. Yesterday it was down close to 8-9%, posted its numbers. It started off in the red, but I think it's pulled back a little bit. Let's get transformers and rectifiers up for you on the screen. Now it's up close to around 0.5% or thereabouts. Power Mech, that's another company in there that's gone ahead and won a decently large size order over a longer duration. Power Mech, a stock that's fallen from 3,500 all the way to around 2,400. Well, that one is seeing some kind of green post that order win. What else is doing well? Cupid is up 2.5%. That one moves on very, very large volume. So keep an eye out on that one as well. And all in all, as we do this 2-minute market check, the markets are up close to around 60 points. There is a reason to see a bit of a bounce, but let's see whether or not this bounce is sustainable, because yesterday's session clearly will be plaguing the bulls. 20 DMA still 100 points away from the Nifty, but a bit of a relief start is what we're seeing. Prashant?
Absolutely, and we need relief. God knows we'll need relief. Well, I think, what do we have, right? I mean, there's bounce across the board. And 1,200 stocks are higher. And I mean, actually, it's 1:1 advanced decline ratio at this point. Gautam Shah is with us, founder Goldilocks Global Research. Gautam, good to have you here. Markets at an all-time high on Monday and down 500 from there on Friday. And so just technically, I mean, how do you reconcile all of this? It's just 9 days into 26, and it just seems like it's a whirlwind of news flow and new stuff thrown at us.
Good morning, Prashant. Before I talk about India, let me just highlight that we are in the middle of a raging global equity bull market. So if you look at US, which is at lifetime highs and still doing well, if you look at Europe, if you look at many markets in Asia, with what Korea has done last year, Taiwan has done last year, China at a multi-year high. So the bigger point that I'm trying to make is that the global equity market bull trend continues. And in this, India has been quite an underperformer, in terms of the last year returns. And I don't think India is going to do anything special this year, at least on a relative basis. On an absolute basis, you don't need too much analyst acumen to say that we've been in a range for the last 6 weeks. I think 25,700 on the downside, 26,300 on the upside. It almost seems as if the market is not prepared to break out. And there is this too much happening on the economy and Trump versus the domestic liquidity that seems to be keeping our market afloat. But I wouldn't be too bearish. I do believe that there is scope for some downtake. But on an index level, with two pillars of the market, which is technology and reliance, not firing in, there is just too much responsibility on the bank Nifty to keep the market safe. So I think the Nifty will keep you interested. It will continue to behave like a pendulum, but I don't see it break out or break down immediately. But there are still a lot of stock-specific opportunities, and I think this year is going to be about stock picking and theme picking. So while the Nifty continues to trade in the range, my case is that we will eventually break out on the upside. But before that, we need to deal with a lot of news flow, and hopefully the government does something in the budget that propels this market.
Do you have a target? Gautam, hi, morning, Reema here. On the Nifty, say for the next 12 months, and you spoke about this being a stock-specific market. Given that overall we could be in a bit of a range, what would your top ideas be?
Well, there's a very clear move from growth to value. why do you think PSU banks did better than private banks? Why do you think non-ferrous did better than ferrous? Why do you think the entire PSE space has made such a good comeback in the last couple of weeks? So anything that was very richly valued has been a big underperformer in the last 3 to 6 months, because the market does not want to discount any more into the future. Market does not want to discount into Excel sheets anymore. It wants to discount actual earnings. So keeping that in mind, we want to be in pockets where valuations are comfortable, relative strength charts are good. Metals have been my favorite. I think every time I've been on your channel, I've spoken about it. I do believe that the metals index can appreciate another 15% from here. So all dips are a buying opportunity. I do believe that the entire PSU pack is the opportunity of the year with across the board strength, apart from defense and railway. So X of defense and railway, I think the entire PSU space looks good. And I'm still pinning my hopes on the bank nifty. I know it's surviving around that level of 60,000, but the way PSU banks are placed and the way some of the private banks are placed, this sector is also likely to make a comeback.
Okay, all right. Hi, Gautam. Good to see you in. Gautam, on the Nifty, what are the targets?
Well, as I said, this is not a market where you focus too much on targets. I think the range is very clear, 25,700 on the downside and about 26,300, 350 on the upside. Eventually, we do believe that the Nifty will break out on the upside. And if that happens, my working number for the next 12 to 18 months is 28,400. But it's going to be a very hard work to move up. And as I said, the bigger opportunities in the mid caps and small caps and not in the Nifty and the large caps.
Coming back to the equity markets in a bit, but what about precious metals? All that glittered was gold and silver in 2025. Do you think both those two have run their course, or is there more to go?
I think they've run their course. I think that's been the view for a month now.
Yeah,
we have seen a parabolic move. The studies are not supportive anymore. And I do believe that both gold and silver are likely to see a large price and time correction. And if that were to happen, I think the focus will go back into the equity markets. I would rather be very bullish on the base metals. I think that's really the trend of the year. You have seen what's happened to copper, aluminum, zinc, lead, nickel. I think base metals is probably the story of this year. And I think the proxy stocks in India and world over are likely to stand out.
Okay, all right. You want to give us a view on the big boy Reliance Industries? I was looking at it on the charts. That one was actually one of the leaders for the last few months. And very quickly, it's corrected from a high, the 52-week high, closer to around the 200 EMA. Now, that's an important stock from a Nifty perspective as well, more than 10% weightage. How is that looking?
Yeah, so we don't have a recommendation, but I think Reliance being 10-11% of the Nifty is obviously a very important stock. Just 3 days back, it was at lifetime highs of 1610. From there, we've seen a bit of a collapse, and it does seem as if Reliance has also run its course at the recent high. So I think it's just going to trade in a range with possibly a negative bias. So that's not going to help the Nifty and the entire market. So that's a problem area. And the entire technology space, I've been maintaining this view for a while now, that technology versus Nifty or versus the rest of tech in the world, I think Indian tech is going to see a big phase of underperformance, maybe by not falling too much, but not rising. It's just going to be in a range with a negative bias. So these are the two pain points of the market right now.
Yeah. No, they are. What about the entire defense space? Thematically at least, Gautam, there is one, अगर मैं हिंदी में बोलूँ एक सारांश जो भी कुछ हो रहा है उसका ये है कि defense, everybody is going to spend a lot more on defense, right? I think Trump last night basically saying 50% they want to increase defense. By the way, US spends more on defense than the next 5 countries put together. They want to increase defense spending by another 50%. So everyone, Europe is remilitarizing. Defense stocks, by the way, global defense stocks, BAE, Lockheed, so many of them, they've all done phenomenally well last 1 year. You think in India that is a theme which will make a strong comeback?
Well, I think defense is still a global theme because the valuations are still comfortable and I don't think they've gone out of hand. So globally, defense is a theme, but I don't think Indian defense is a theme. We all believe in the concept of discounting. And I think the next couple of years, all the positives are already in today's prices. And many of the top defense stocks are trading at very, very rich valuations. So I don't think defense is an opportunity. As I said, I don't want to do any sort of adventurous investing at this point of time. I want to be in brick and mortar companies which don't get impacted so much with foreign policy. And that's probably the reason I'm very comfortable with banks, metals, and PSU.
maybe slightly leaning on into the fundamental territory. Budget is around the corner, right, Gautam? Any plays out of there? I mean, matching expectations with technicals, Gautam? Anything at all?
See, firstly, I think our market has been supported completely by domestic money. And I'm sure the government realizes that with 30,000 crores coming in every single month. So the Indian investor has showed its confidence. The government has done a lot in the last 1 year with GST and the income tax measures. The RBI governor has been firing in for the last 6 months, doing all sorts of positive measures, which is great. Now the economy needs to show up. And I think capital market participants need to be awarded. So possibly the government might just want to do something on the capital gains, because you want more investors in this market to stay committed for the long term, with FIs unlikely to return anytime soon, given the relative strength elsewhere and opportunity elsewhere in the world. It's important that our economy and our market participant survives. And for that, I think the government needs to keep delivering. Hopefully they will deliver on 1st of February.
Yeah, they will deliver, hopefully, right? I mean, and it's a Sunday, Gautam, so we'll be, of course, in office and reporting. Markets have turned, by the way. They've completely turned. Just look at the NSE advanced decline. And I know it's still early to look at the market breadth, but it just swung the other way violently. We were 1:1, and now it's 3:1, declines to advances. Some 1,900 stocks are lower, and about 700 stocks are higher. So on your screen now, the Nifty is down about 30-odd points or so. At this point in time. If you can just look at Reliance Industries, I mean, RIL is still in the green, but it's also come off the highs by about 6-7 rupees. What else? So the index is not down that much. Maybe you can just look at the indices, mid-cap and small-cap indices. Mid-cap index is down a third. Mid-cap index sold off 2% yesterday. The small-cap index, of course, has been an underperformer anyway. It was also down 2% yesterday. Small cap index is losing another 1% this morning already. So, yeah, I mean, things are not lasting. Things are not holding, at least at this point. These, look, pull up Hitachi if we can. Hitachi is selling off now, 3.5% on this one. So, it's so sharp sell-off, right, yesterday on Hitachi. And it's down another from the highs. By the way, the high today was about 18,540. And about 17,860 now. The other one is GT&D, 3.5% lower here also. Balaji Amines was a big mover yesterday on the upside. That's down 4%. And the other one is Panacea. Panacea Biotech was up 10% yesterday. And I was saying, this thing is, the dengue vaccine could be substantial, very meaningful, but it's 2 years away. Panacea went up 10%, is down 5% right now as we speak. A bunch of other names, Force Motors, huge outperformance, just a pullback. Thangamile Jewelers recently, sharp up move, down about 5% right now. Godrej Properties is down about 3%, and so on and so forth. So a bunch of names coming through in the broader space that one is looking at. Gautam, just one last question to you. One name that you'd be happy to hold positionally and sort of accumulate through the course of the next few months.
Well, as I said, I think markets are in a difficult space and don't expect the kind of rally that we saw in the last 3.5 years. I think we all used to seeing India being the poster boy in the global basket. That's not happening anytime soon. This will be a theme pickers and a stock pickers market. And I think the entire PSU space is something that we really like. So the top names there, the top 3 or 4 names there stand out for us. And I think that's where our commitments are right now.
SBI, I'm assuming, right? Top is one of them.
That's correct.
Okay, fair enough. Gautam, we'll leave it there. Thank you very much for joining us. Good speaking with you, and chat again soon. But there is a big, and Gautam was talking about PSUs, right? There's a big PSU IPO which is opening from the coal space. Coal India subsidiary coming to the market. Najal, take it away.
All right, well, let's get straight. Bharat Coking Coal's 1,070 crore rupee IPO. Well, it opens up a subscription today. The company is a wholly owned subsidiary of Coal India and is also India's largest coking coal producer. To help us out with details with regard to how the company progresses from here on, we're joined by Mr. Manoj Kumar Agarwal, the CMD of BCCL, and also we're joined by Mr. Mukesh Agarwal, the Director of Finance at Coal India. Good morning, gentlemen, Mr. Agarwal, and welcome to the stock market. Well, we're looking forward to another entity. I recall years ago when Coal India listed, there was a lot of excitement out there and the big pop that you saw on the listing day itself. The street will be hoping that BCCL does the same. That said, let's understand a couple of aspects of business. Mr. Agarwal, coming across to you, Mr. Manoj, you plan to increase production to around 50 million tons, right, by 2030. As of now, you're ballpark around 40 million tons. Could you tell us this incremental volume, what is it dependent on? New mines starting or the ramp up of the existing mines?
Good morning. Actually, you have to understand BCCL, Bharat Coking Coal Limited. Presently, we are doing 40.5 million tonne and 29-30 we will go up to the 56 million tonne. And as you asked, our main focus will be by increasing the underground production by applying new technologies like high wall mining, continuous miner, and like way, we are also monetizing our old stopped underground mining. We have awarded 5 old stopped underground mining, and one of them has already started production. And second thing, our 80% production comes from the open cast mines. We are operating in BCCL total 34 mines, 25 open cast mines, 4 mixed mine and 4 underground mines. And in open cast mines, you have to understand our geological condition of the BCCL having headquarters in Dhanbad. We are having 16 seams, and due to less area to operate, as we are facing, there is some space constant. We are amalgamating our small mines into a large mine. And last year, one of the mine, NTST Lodhana, has started with 6 million tonne plus, and now onwards it will go up to the 8.5 million tonne.
Okay.
So in this way, our production will improve up to 56 million tonne in 29-30. And one thing more, our production is directly attached. Coking coal is directly attached with the steel industry, and they want vast coal. We are having washeries, 5 washeries having 13.65 million tonne per year capacity, which will also go up to 29-30, around 27-28 million tonne.
Mr. Manoj, we have this detail, sir, with regard to this, and you have mentioned that as well. So let's get a couple of other aspects that are going out, since the focus is obviously going to be on washed coal, which in turn then can be used by the steel industry. So let's get a few parameters out. Tell us, what is the EBITDA per ton difference for washed coal as well as what you're currently selling? How does it differ with the blended EBITDA per ton? How much better is it?
After washing of the coal, the price rises like anything.
Okay.
And we are having 39 to 40% as content coal. And after washing, we will reach up to the 18 to 19% as content coking coal. And with imported coal by steel industry having 8 to 9% as content, they blend their coal with our domestic and imported coal, and desired rate 12 to 13% as content coking coal. With this coking coal, they produce steel, and around 17 to 1800 rupees per ton. It will increase after the washing. That is, rate will be from the 10,500 to 14,000 rupees per tonne.
And all this incremental realization, most of it will flow to the EBITDA per ton, sir? This 3,500 rupees per ton, most of the realization gain?
In a simple word, delta becomes 3 delta. In the terms of the EBITDA. And it goes to the entirely to the P&L.
So just Mr. Mukesh Agarwal, since you're going to give us some numbers out there, in simple terms, the blended EBITDA per ton for the company is how much of BCCL? And
it becomes, normally it is 400 to 500 rupees. When it will be washed, it will go to 1700 rupees per ton.
Okay, EBITDA per ton, right?
Yeah.
Okay. Mr. Gentleman, good morning. This is Reema here. Mr. Agarwal, Mukesh, if you could just talk about the dividend policy, because that is something that, the street gets very excited when they hear about a PSU. So from BCCL, what is the mandated dividend policy?
Madam, in the Coal India, all the companies are following the DIPAM guideline for the dividend. Though those are unlisted companies, but they are following the policy of the DIPAM. That is 30% of the PAT or 4% of the net worth, which is the minimum that all subsidiaries are following. And in the coming days, Bharat Coking Coal will also follow the same policy of the DIPAM, minimum dividend. Maximum they can go as per the availability of the cash.
Got that. So that's on the dividend policy. And one more question, Manoj, since we were talking about the increase in the EBITDA per ton with more contribution coming in from washed coal, etc. When we last spoke, you gave a top-line target of 20,000 crore by 2030, which is when your expanded capacity comes on stream. What would the absolute EBITDA look like or the margins?
Actually, presently we are giving steel industry around 1.7 million ton clean coal. Up to the 2930, our production of clean coal will be around 9 to 10 million ton. And also we will supply 10 million ton of the raw coal to our nearby washeries of Tata, like that, in Jindal. So production of the clean coal, washed coal will be improved, and that way EBITDA will also be improved, and it will be very much beneficial for our investors. And in this continuity, I will also like to mention that our reserve is around 8 billion ton, and it will last more than 100 years. So there is every benefit for investor in every sense.
Okay, all right. Just to clear the point, sir, at that 20,000 crores of revenues, what could the margin look like? Since the EBITDA per ton is going to go up by such a vast proportion, your contribution to the steel sector's demands as well is going to go up. So how much higher can the margins go?
Actually, in the 2030, we had projected net profit of around 2,900 crore rupees.
Okay.
And if we will convert into the EBITDA, it will go around 5,000 crore rupees plus.
Oh, all right. So that you're talking about a big jump in the EBITDA number. As of last count, you're doing close to around 1,200 to 1,500 crore rupees of PAT. But now you're saying that by 2030, what will the number be, sir, on PAT?
2,900 crore rupees around.
2,900 crore rupees. Got that. All right. The one fear when you have a PSU, and I've seen various issues with Coal India for the last 15 years as well. What is the trajectory on the employee cost and the number of employees from here on? As we know, employee cost as a percentage of the total expenditure is around 50 to 55%. And the last count I have, total number of employees you have is around 31,400. Employee cost is around 650 crores. But both those numbers have been gradually coming down. So how do you see both these two move?
In terms of BCCL, what is the projected employee is around 22,000 employee will be there by 2030. And with the natural attrition of the employees' cost will go down. But simultaneously, wage revision is also due from June 26. So it will be almost decreased by 10% because of the wage revision. The corresponding reduction will not come. But 10% we are expecting the employees' cost will come down in the near future.
Okay, and what is the proportion, sir, of this employee wage revision? Because various times you've seen that the employees go on strike, the demands are not met. You've given us a timeline later in June, but normally what is the quantum?
Normally the wage hike will be around 15 to 20%.
15 to 20%. Okay, all right, got that. So 22,000 employees, the employee cost comes down. But then there's another element, right? The contractual coal. That's a contractual cost that you have as well in your books. So how much contractual coal was mined last year? And in that mix of around 56 million tons, what will it be like?
Our production by contractual means will be around 75 to 80%. By MDO means or hiring of the coal and OB. So it will be around 80-85% in 29-30 of the contractual production And we are also expanding our mines through contextually. So it will be in the limit of the 80-85% of the contextual production.
All right, Mr. Agarwal, before we let you go, just throwing this out to you all, just for some closing comments. This year, you're going to end with a degrowth. That's a well-known factor because of the flooding and various other factors. But you have a longer trajectory ahead. If you were to give a message to the investors that are looking to subscribe to this issue, what would that be? There'll be a lot of them who are watching this interview and want to know whether or not they should be subscribing. So what do you tell them?
Just you have to know, mainly our Bharat Coking Coal Limited is the strength is our coking coal and washery, and importing from the Australia, our production will increase, then our import will decrease, and it will improve our country mission of the Atmanirbhar Bharat, and investing in this company will be beneficial in every sense for every our investor, as our coal reserve is more than 100 years and it is a 50 years old company. There will be no any doubt about the investing in our company.
Got it. Okay, all right, Mr. Agarwal. Appreciate you all joining in, Mr. Manoj as well as Mr. Mukesh. Wishing you all the best. Valuation-wise, it appears pretty much in line with what the street was working with. And I believe there's a lot of interest as well. So subscription could very well be oversubscribed. And maybe, in fact, there'll be some listing gains as well. Thanks a lot for educating us on the business. On listing day, we request you to join back again and educate us about the near-term as well as the medium-term outlook. All the best for this issue.
Thank you. Thank you.
Time to slip into a short break. On the other side, Reema will be waiting for us. She's going to be taking us through our special segment, Quarter Se Quarter Tak, and we'll be focusing on the tech space. Stay tuned.
Okay, welcome back. It's our special segment, Quarter Se Quarter Tak, where we get your earnings expectations from a sector every day. And what else but IT, which is going to be kicking off the earnings season in right earnest. Reema has walked across to the wall with expectations. Reema, over to you.
Thanks so much for that. So as the December quarter earnings season kicks off for Indian IT, expectations are fairly anchored because Q3 FY26, that's the December quarter, is generally a seasonally weak quarter. There are furloughs, holiday, year-end, client shutdowns. So let's now begin with the top line, the constant currency revenue growth expectations on a quarter-on-quarter basis. For large caps, it's going to be very modest, but mid caps is actually going to be much better. So this is what the CNBC-TV18 poll throws up. It will begin with TCS. That's the first one to report numbers on 12th evening. A CNBC-TV18 poll throws up a top-line growth of about 0.5%. Then you've got HCL Tech also on 12th, and that is going to lead with a top-line growth of nearly about 3%. And that is largely on the back of strength in its products business. For the other two, as you can see, it's a very low single-digit kind of a top-line performance. Now, mid-caps, once again, are expected to outgrow the large caps. And the two stocks that the investors are very keen on is Persistent and Coforge. And these two are likely to see about a 3.5% constant currency revenue growth. Now, at a broader level on the demand front, it's not positive, nor are there any negative surprise. The demand environment has not materially changed in the last 3 months, though JPM recently flagged off some improvement in the auto tech spends from the OEMs, which is positive for ER&D companies. But other than that, we haven't seen any sharp increase in discretionary spending. Cost takeout deals continue to dominate, and the AI discussions are active, but large monetization still remains very limited. Now moving on to the FY26 guidance. And I think the headline here is that the guidance is narrowing, but it's not upgrading. So Infosys guidance was about 2 to 3%. It could come to about 2.5 to 3%. For HCL Tech, the guidance was 3 to 4%. It could come at 4 to 5%. And both these companies are likely to maintain their margins despite the INR tailwind, on the margin front. On margins, while the rupee depreciation, the FX helps, but but margins are still likely to remain structurally range-bound. So here's how the currency moved in the quarter gone by. The USD-INR pair moved from 87.3 towards the end of Q2 to 89.1. And that is about 2% quarter-on-quarter rupee depreciation. And if you look at it on a year-on-year basis, it's about a 5.5% revenue rupee depreciation. Yet, despite that, margins are still likely to remain range-bound in Q3 because some companies have a wage hike, there is the furlough impact, and AI-led pricing pressure. I think the key question investors will ask and listen for is calendar year demand commentary, tech budgets. Are we finally seeing budgets improving, AI monetization clarity beyond pilots and a productivity talk, and discretionary spending recovery still remains elusive. Finally, let's put the stock price and the valuation in context. Now, the Nifty IT index did well in the October to December quarter. From 1st October to 31st December, the Nifty IT index was up 14%, outperforming the benchmark by nearly 4%. Despite this, the index is still underperforming. In the last 1 year, it's down close to about 12%, and this is the valuation. For large caps, as you can see, it's between the 20 to 24%, largely 24 times, largely within the long-term average. Mid-cap valuations are superior, but then they are growing faster in a softer demand cycle. Back to you guys.
Okay, all right. Thanks a lot, Rima, for that. Well, let's hop across to Yogesh Agarwal, Head of Research, HSBC India, who joins us on the show. Hi, Yogesh. Good morning and good to have you on the show, Yogesh. Help us out with the top 3 points that you're looking at from these IT companies in this particular earnings season.
Nigel, look, this quarter is usually a seasonally weak quarter. And therefore, it's not going to have a significant impact on the numbers or the outlook. However, we do expect a little bit of positive commentary from the management. I think the last year, if you see the second and the third quarter results in the US were particularly positive, almost blockbuster results. But the IT spending remained weak. And there was a lot of uncertainty around macro tariffs, and customers held on to the spend also related to AI as well. We are seeing that relaxing a little bit. We may not be back to the March sentiments last year, but we are certainly closing into the March sentiments. And therefore, we do expect a little bit of positivity in the management commentaries this quarter.
Okay, so management commentary in the current quarter will be better than what it was in the prior quarter. Yogesh, hi, Rima here. So growth expectations are well anchored. We know it's going to still be an improvement in growth for this year versus last year, but not a runway growth. Maybe for large caps, it will be about 3, 4, 5%. Mid caps a little bit better. But are there any stocks or pockets where you are seeing a valuation mismatch, where one can actually, take a tactical or as an investment idea because of a mismatch in valuations?
Yeah, Rima, look, first of all, I think big picture, I don't think this sector can grow double digits on a sustainable basis. We are just too large. Just to give you a context, we think at least 1/3 of the global IT work is done through India today. Okay, so at that scale, gaining market share to grow double digit is just not possible. So we are quite linked to the global tech spend growth, which means that on a sustainable basis, larger companies probably can grow mid-single digits. And therefore, it is very tough to see a very high double-digit compounding in the stock prices as well. So where investors could see more value is smaller companies, because what has happened 10 years back and now, scale is no more a significant advantage when you go bid for a larger deal. And therefore, smaller companies are getting the same place on the table as a larger one. And hence, at their scale, they can grow faster on a sustainable basis. Some of them can grow high single digits. Some of them may actually grow double digits as well over the next 3 to 5 years. And market craves for growth. So as they grow double digits, I think the stocks can compound as well. And despite the premium valuations of mid-tier, they may still compound. So I think that's where there could be a lot more value than top tier, if you're looking at from a long-term compounding perspective.
So when the IT index did well in the October to December period, we saw that relief rally, recovery, outperformance. Yes. When you spoke to investors, both domestic and foreign investors, what was their reading of that outperformance? And what is the holding now or the view?
So, Rima, last year we were overweight on the sector purely because we believe that IT growth outlook will improve this year, and stocks, therefore, although at the bit of a reasonable valuations, could outperform the market. In fact, this quarter in our preview report, we have downgraded the sector to more market perform. Inline performance this year, because the stocks have run up 10 to 15% already. So I think what has happened is through the year last year, there was a realization that AI is not is negative. Obviously, in the near term, there is a deflationary impact, but not as negative as what people thought earlier in the year. And secondly, there is a lot more comfort around tariffs, and the corporates are a lot more comfortable to increase the spend this year on an overall transformation and overall tech spend. So both these factors led to a little bit of a better confidence for this year, and then hence the stock prices reacted to them.
Okay, thank you very much, Yogesh, for joining in. We hope you can join once we start getting the individual companies and the earnings results from them. Vikash Kumar Jain, India strategist and head of India Research, CLSA, is now joining in. Vikash, thank you very much for joining in. You believe that the reduced relative premium to peer markets after India's record underperformance in 2025 should improve the acceptance of India. So lay out for us, how do you see 2026 to play out, and what your big bets and themes would be?
Hi, Rima. Thanks for having me. So 2026 is a little different from 2025 because we have this, I would say, divergent forces for India. Firstly, the relative valuation has become more palatable. And what that has done is maybe foreigners can start looking at India. But at the same point of time, despite record underperformance of the market last year, we find the market actually slightly higher on PE than where it was at the start of 2025. So from that perspective, absolute valuations do not leave a lot of room for re-rating. So the way we think about it is, if during the year, due to global fears on consolidation in the AI space, on the AI global bull market, or fears of a yen carry trade, leading to some kind of a need for defensiveness, that's where India becomes an acceptable portfolio hedge globally. Within our domestic setup itself, I think 2025 saw a lot of large policy announcements in the form of income tax cut, in the form of GST cut, in the form of even several rate cuts. 2026, from that perspective, will be less about announcements, because I think a large part of the fiscal and monetary room for the government is gone. I think they will continue on fiscal consolidation. So they would want to wait and see what these measures finally, what is the impact of that, and whether that they wait for the growth push that these measures would provide. And therefore, less of a top-down noise, other than, of course, the trade deal thing, which I think is an early 2026 event, perhaps a trade deal with the US as well as EU. Beyond that, I think there will be a little bit of a lull in terms of announcements, and then the wait of when the announcements of last year pushes up growth in 2026. So broadly, with that, not expecting any fireworks, relatively muted performance is likely in 2026. But the focus would be in areas where lower for longer rates, a big push towards consumption. So consumption and rate sensitives, along with, trying to play the headlines on trade deal, basically India's relationship with the US eventually improving. All of that should help certain sectors. And that's where we have our favored overweights are consumption, real estate, and IT.
Real estate, consumption, and IT are the three areas where you think you want to be constructive on. Vikash, hi, morning, and I wish you a good 2026 for you personally, and of course, for markets as well. Within these three, in terms of what you've published out there, which are the top 2 or 3 ideas in each of these 3 sectors? Talk about what you've already published, so it's out there.
So I think, see, you possibly, you guys have our reports, and we did make a few changes to we doubled down on consumption. We added a few retail names to our portfolio because we believe that after the recent, our relative sideways movement, risk reward had improved in some of those retail names and quick commerce names. So those are some of the names that we recently added. Clearly focused on consumption, overweight on staples slightly, overweight on autos very clearly, overweight on discretionary. So, and real estate is the other name, other sector that we like.
Okay, all right. Hi, Vikas. Good to see you in, Vikas. So in terms of moderate returns for this year, you think on the Nifty we should get high single-digit returns?
Yeah, I think that should be the best case. See, I think the setup that we have is perhaps we continue with the global bull market. And in that setup, there is no real requirement for us to, maybe the chances of a sharper correction in India goes away. So we are in this gradual derating period where multiple keeps coming down, and that's where returns will be perhaps lagging earnings growth, and that's where the gradual derating kind of plays out.
Okay, all right.
High single digit could be a good case.
All right, so that's on the Nifty. The other, big factor, and I think the voices that I hear are actually split with regard to crude. What's going to happen to crude oil from here on? Because we're talking about US going in there, ramping up production in the Venezuela. It'll take a few years, obviously. But then there's a geopolitical risk as well. So from around this $60 per barrel mark, what are you all working with in terms of the movement of crude oil prices? End the year closer to around 70 or dips towards 50?
So it's the former. So we believe that, see, on the face of it, if you were to look at just simple like Excel numbers, crude oil market looks oversupplied. That oversupply, if I were to look at, what demand and supply numbers are being talked about, is in the range of about somewhere around 400,000 to 500,000 barrels a day or so. So looking at that, I think any kind of geopolitics, political risk, say some kind of stringent action for people buying oil from Russia and some of those other things can easily take away that kind of a supply and make the market, balanced. Since an oversupplied market is the nervousness that is baked into the stock price, a more balanced market, which could happen due to these geopolitical risks, either in Iran or in Russia, could easily allow crude prices to recover. So we are more in the range of that 70 plus as the year passes. So a recovery in, from the lows of the start of the year is how we think of crude prices.
So just to close the loop on that, Vikas, you'll be more moving now towards, I think, Oil India and Reliance Industries rather than the OMCs. You'll play it as a tactical bet earlier, right?
That's right. So we like the upstream more. Upstream stocks more than the downstream ones.
Got it.
Got that. Vikas, we'll leave it there. Thank you very much for joining us. Good speaking with you, and appreciate your time here on CNBC-TV18. So that is the conversation with CLSA's Vikas Jain. I just want to quickly put out a small plate with what is coming in just now, and I think it's pretty startling. So this is the U.S. Commerce Secretary speaking in a podcast. It's called the All In Podcast. Howard Lutnick, the Commerce Secretary of the U.S., with regards to the India-U.S. trade talks. Actually, we are just putting out a small portion of it. We're still getting more detail of what he said. There is more. He explains how all these trade deals got done. But for now, let me just read this out, right? He says, let's be clear, it's his deal. That's President Trump's deal. He's the closer. He does it. It's all set up. You got to have Prime Minister Modi call the president. They were uncomfortable doing it. So Prime Minister Modi didn't call. That Friday left. In the next week, we did Indonesia, the Philippines, Vietnam. We announced a whole bunch of deals because we negotiated with them and assumed that India is going to be done before them and negotiated with them at a higher rate. Basically, the assumption was that India will get a better rate than all these countries, and the other countries essentially were done at a higher rate. So now the problem is that the deals came out at a higher rate, and then India claws back and says, oh, okay, we are ready. I said, ready for what? it was like 3 weeks later, I go, are you ready for the train that left the station 3 weeks ago? So that is the US Commerce Secretary on the India-US trade deal. As I said, there is more. And, there is a portion where the Commerce Secretary explains how these deals got done. And in their minds, the Commerce Secretary explains the way this was going to be done is that the country which approached the US earliest got the quickest and the lowest best deal, which in this case was the UK. And then that kind of that became the floor, and so on and so forth. I mean, the Commerce Secretary describes it as a staircase in terms of countries who came later, perhaps got higher rates. I mean, at least that was how they were thinking about this. So I think this is important, and I think provides backdrop and context, of course, to these prolonged negotiations, which have, of course, been underway. At the bottom of the screen as we speak right now, what we'll do is we'll put out more, the thinking behind how these deals got done, because that will provide the full context of what I'm talking about. We take a quick commercial break here. We'll have Balaji Subramaniam of IIFL Securities to discuss the Vodafone, the relief that has come through for Vodafone Idea. Stay tuned, coming up.
Welcome back. Let's put the spotlight on Vodafone Idea, Industars and the entire telecom space. Significant relief coming in, AGR relief coming in from Vodafone Idea for DOT. And now we've got official communication, from the company when they intimated it to the exchanges. Balaji Subramaniam from IIFL Securities is now joining in. Balaji, thanks for joining in. First, outline the cash flow relief for Vodafone Idea versus the earlier situation.
Hi, good morning. Thanks for having me on the show. The big relief has been that if you look at what was mentioned in media reports last week, it said that the relief is primarily for the next 5 years or 6 years. And from FY32 onwards, they will have to make the payments in 10 equal installments. But actually what the company has notified today is that the relief is until FY35. And the payments will be only from FY36 onwards. Not only that, they have also quantified the payments that they will have to make in the next 10 years, which is a maximum of 124 crores per year until for the next 6 years. And subsequently, it's about 100 crores per year for the subsequent 4 years. So what that means is that their cash flow payouts on the AGR matter will be not more than 125 crores for the next 10 years, which is a significant relief versus what the original payment schedule was, which is like 16,000 crores for 6 years from FY26 to FY31. So I think as far as the AGR matter is concerned, of course, we will have to see whether there is any reassessment of the dues after the detailed audit that the DOT conducts. But all that is for, a period which is 10 years out from here. And I would argue that, if the liability is frozen at today's level for the next 10 years, so effectively in PV terms, it's about a 65% relief because basically, the company doesn't have to bear the time value of money. So net, I think the AGR matter is, more or less settled as far as, the cash flow implications and the stock price is concerned, at least for the next 10 years.
But Balaji, morning, Prashant here. Does it change your per share value for Vodafone Idea?
So the thing is, one has to look at that versus what is already priced in. So I think the thing to note here is that AGR liabilities were only about 40% of the government debt of Vodafone Idea. The remaining 60% or 1.2 lakh crore rupees pertains to their spectrum debt. And that is, that is a big issue because while the payments are not that meaningful, I think they have to pay about 6,000 crores next year, followed by 15,000 crores in FY28. And from FY29 onwards, for the next 5 or 6 years, they have to pay a sizable 25,000-26,000 crores per year. So I think that is also something which needs to be taken care of. One way that might happen is some fresh investor coming in, equity investor coming in, and the government getting diluted because of that investor coming in, and subsequently the government converts more spectrum debt into equity. So that can be one way of that happening. So the thing is, even though the cash flow will significantly improve, and based on that, if the fundraising goes through debt, equity and all, then I think the equity value creation will be meaningful. But of course, the catch here is that there will be meaningful dilution, and it depends on at what price the fresh equity issue happens and the government conversion.
No, Balaji, the government may dilute its stake. It doesn't have to be fresh equity, does it?
No, but from where will the company get the money to?
No, that is the whole point. My only thing is, the bigger question is, with this AGR matter, as you said, now settled, does the company become investable? Can you imagine a scenario where this once again becomes, market cap is already 1,30,000 crores. Can it generate, will it become a healthy, robust third player in that sense? With this review, can you imagine a situation such as that?
I think that is still far out, because there are many things that need to fall in place for Voda Idea. And this is a good first step, a meaningful first step in that direction. But after that, as we spoke, some of these measures have to come in through a combination of debt and equity. They will have to raise enough funds so that they can do the capex. And once the capex is done, they will have to ensure that that really translates into execution on the ground in terms of stemming their subscriber losses, and also ensuring that when the tariff hikes happen, they will have to contain the extent of down trading and churn. So I think so many things have to fall in place before one can say that Vodafone will be a reasonably competitive number 3 player. So I think, based on where the stock price is today, I think a lot of it is actually priced in. And if there is going to be more equity dilution, even if we assume that someone really comes in and puts equity into the company, I think a lot of it is actually in the price. Especially,
you do believe to meet the spectrum liabilities, which stand at 1.2 lakh crore, the company will require equity funding. That is your base case scenario as of now. Balaji, the street is now banking that with this AGR relief, the company will be able to raise that bank funding of 25,000 crore rupees. But there is still some uncertainty on the overall quantum of AGR dues. It's frozen at 87,000 crore, but there is a committee which is going to be formed which will reassess the dues, which means there is still a possibility that the AGR dues may come down further, providing relief. So till we get the clarity, do you not think investors will want to wait? Even banks may not want to wait. I mean, bank funding may not happen till we get clarity on the overall quantum of AGR dues. I mean, is that a likelihood or the way it should play out?
I think that is less of a concern, at least to me, because 10 years is a long enough period. And we are talking about FY36. So most bank loans, if you see, there are not too many bank loans which you take for more than 10 years. So at least from an AGR standpoint, I think we are set for the next 10 years. And let us not forget, as I mentioned in my opening remarks, if the liability is frozen for 10 years, that effectively means that there is a 65% relief in the liability quantum, because if you compound something at 8% per annum, which is what the AGR dues were compounding at. So for 10 years, effectively, that if you do the math, it translates into a nearly, 65% reduction in PV terms. So, let us not forget that as well.
And one final question, what does this mean for Indus Towers? Are there any overdue receivables? What could be expected from the Vodafone Idea capex, which boosts Indus Towers?
So it is positive for Indus, and I think that has been getting built into Indus stock price as well, because I think maybe 4-5 months back, Indus was trading below 350 or around 350. And the stock has nearly gone up to 445, 450 on the back of the expectation of a relief coming Vodafone Idea's way. So it is clearly positive because once Vodafone Idea starts rolling out, especially on expanding its 4G coverage, you will see the tenancy ratio improving for Indus. And Bharti also is continuing to do rural 4G rollouts, even though they may be close to the fag end of that rollout process. So I think the numbers for Indus should improve going ahead, and there are no overdue receivables because whatever was due, around 5,500 crores, was paid by Indus. Once Vodafone Idea completed its FPO last year. That part is taken care of, and there will be some improvement in tenancy ratio, as I mentioned. But I think at 445, 450, a lot of it is already priced in. Of course, there will also be some support technically because Bharti has said that they would like to increase their stake in Indus by up to 5% during FY, or rather, during the next 12 months. That will be a support for Indus, but I think most of the rally is clearly done.
Thank you very much, Balaji, for joining in. Need to slip into a break. On the other side is our special segment. It's the economy. Lata will speak to Goldman Sachs economist Shantanu Sen Gupta. Stay tuned.